Let's talk about VA Earls. And I don't mean a guy named Earl. That's a dad joke. VA Earls. So an Earl, an IRRRL, stands for interest rate refinance loan. So interest rate reduction refi loan. So uh, ultimately, guys, they just call it an Earl, IRRRL, right? Interest rate reduction refinance loan. And what it means is that you have homeowner has an existing VA loan on the home right now, and it's got a rate of X, doesn't matter. Now, let's say rates are lower than X. So now somebody wants to take that existing VA loan and they want to refinance it and reduce the interest rate, and that's into another VA loan. And that's what a VA IRRRL is. A VA IRRRL is taking an existing VA loan, refinancing it to another VA loan for the sole purpose of reducing the interest rate. The really cool part about these is that they are super, super crazy easy to do. Meaning, so the VA, God love them, the VA already has your mortgage. Like you already make your payments to the VA. So they figure because now whoever has that VA loan refinancing into a new VA loan, they already have the risk. They already own the mortgage. So by just doing this and reducing that interest rate, they make it to where the qualifications are like next to nothing. It's really cool. You don't need pay stubs don't need anything to like prove your income. The only assets we'd ever need to document is what's going to be due at closing. We don't need to document every dollar you ever own. Credit limitations are way easier. So that's good. You do need to make sure you paid your mortgage on time. But the qualification piece is much, much easier. The bad news about the mortgage industry is that there are jokers out there that absolutely, how to say this nicely, they just prey on the veteran and the VA loans for their IRRRLs because they are so easy. They are so quick to do. This is designed for like a call center because you don't need a lot of skill to do them. You need some, don't get me wrong. But these call centers can go out and they just take advantage of veterans and just say, hey, we can reduce your loan from X to X minus something. And they do their best. It's called churning to just refinance this as many times as they can over and over and over and over and over. So it gets a bad rap for these in the industry because these lenders are just predatory and they come after the vets that have these mortgages. So talk to somebody, the mortgage mark team, that can help just make sure you're doing it for the right reasons. There are some guidelines that they've now put around this because of this, and I forget when it was. It's probably the 2010s, early 2010s, somewhere in there, where the mortgage world came out and said, hey, guess what? You can't do a VA IRRRL for at least until 6 payments have been made. So that means you need like 110 days because by the time you close, you skip a month before you make your first payment, you make 6 payments. They've now said you can't refinance and do an IRRRL within that time period. So trying to slow down this churning where people were just refinancing veterans like over and over and over. Like what was happening is that some of these bad lenders were putting people into higher VA loans, interest rate loans, and then almost immediately calling them up within a month or two and refinancing them, but not going as low as they could or should have. They just refinanced them enough to where it made a little sense, and then they call them up a month or two later and do it again and again and again, as opposed to just giving them good advice and just doing one loan maybe a few months later when rates were coming down. So that's where the churning started. That's why some of these parameters have been set. Now also to do the VA IRRRL, it needs to be a 0.5 point reduction in rate at least. There's a whole worksheet that the industry has to do. We have to do it to say, here's the benefit, got to show the break even for the cash and all that stuff. So there are guidelines that are trying to set to protect the veteran, but that doesn't mean the bad guys went away. So just make sure you're doing what you need to do to get a IRRRL for the right reasons. That actually does save money. So something also to note. So an IRRRL is not the only way to refinance into a VA loan. If somebody wants to refinance from a VA loan to another VA loan, they can be done not as an IRRRL, but as a full credit qualifying loan, and that's fine. And just so you know, that'll be called a quote cash out, using air quotes, but that is what it's called. Is when it's a VA refinance and it's not an IRRRL, it's a VA cash out. Why they give it that term, I don't know. But even if you're not getting cash out, they're still going to call it a VA cash out. So there are limitations on that as far as like the LTVs, like 90%. There's some other things you do need to full credit qualify. So keep that in mind. But at the end of the day, the VA IRRRLs are super amazing, wonderful tools where it can save the veteran a lot of money and more importantly, a lot of time because again, from paperwork, they make it really, really easy. There's no appraisal needed on those IRRRLs. Loan to values can be higher, then it doesn't matter what since there's no appraisal, it doesn't matter if your home went down in value or not. So that's good. But beyond that, like I said, it's an awesome tool. Funding fees, they do come into play. So if you're a veteran, if you're not exempt, so you have to pay the funding fee. The nice part is the VA IRRRLs, it's reduced more than normal. So that's a good thing as well. But if you have any questions, please call us. The Mortgage Mark team is here to help. As always, we appreciate you watching and reach out to us with any questions.